This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's get to that chart deck. Now, listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have our Research Roundup email, that means you are not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Louis' picture saying, looking for the downloads. And joining us to talk some charts is Nick Galarnik. So, Nick, great to have you on again here. Let's talk some charts.
Great to be on, Patrick. On page 2, we have the SPX. Eric, what are you thinking on this?
I think there's a very real chance that we're seeing the beginning of a substantial bounce that has the potential to be as big as the July-August summer rally. The setup here was too many people were expecting an October crash, so they were fully hedged for it. So the market did the opposite. I don't think anything has actually gotten better, but markets never move in straight lines, and this one was already oversold. Now, to be clear, I am absolutely not ruling out an outright crash. The geopolitical situation couldn't be a whole lot worse, and our policymakers seem intent on making it worse if they possibly can with ill-conceived policy. But with that caveat firmly in place, it looks to me like maybe it's time for a significant bounce. I still think we're going to see lower lows before this is over, but it feels to me like we're maybe at the beginning of a bounce. We'll see what happens.
Yeah, Eric, that's sort of my thinking too. That Nick, I know you were watching a couple of these levels on the S&P. Where are your levels?
I'm seeing heavy resistance overhead at 3,800 roughly. Current spot as we speak is 3,675 roughly. Support is at the lows of 3,550, heavy support at 3,500. Looking out to the November 11th OPEX, reason being is that factors in the November midterm elections in the United States. Expected move right now is about 210 points in either direction, and that denotes about a 5.7% move. So we can see a lot of volatility over the next couple of weeks, and then it should die down a bit. What levels are you watching for on the S&P right now, Patrick?
Well, you know what? This has been a pretty significant downtrend. What was interesting is on that CPI number last week, this started with some heavy selling, and then we had that huge intraday reversal that really kind of solidified at least a short-term low. There's a lot of people out there that are talking about whether or not that could have been a more meaningful bottom, and that's really what's on my mind. I mean, right now, obviously, like you were referring, we are in the OPEX going into the option expiration, which usually pins the market, at least for the next day. But next week could be quite volatile. And one of the things that's on my mind is whether or not the bulls can actually follow through and beat that October high and get this market above 3,800. Because really that could set in motion a rally into the midterm elections and potentially stress the top side of the market. But what is interesting is how fast traders are always quick to want to buy dips. And this market is just set up for so much volatility. And with these little fake outs, it wouldn't surprise me if the market causes some serious moves. But like I would actually prefer this bull move to materialize. But if for whatever reason we find ourselves next week with the market fading below 3,600, it could cause another wave of liquidations that could see us heading to some of those big targets that some of our guests have had down at 3,200 or lower. And really, the big question is the market going to stay flat into elections? I think there's a big move coming, and whether the bulls can actually turn the trend, it's going to be all about that 3,800 level early next week. But, you know, Nick, though, I want to talk this VIX on page 3 because the VIX and the volatility has stayed at elevated levels through all of this. And that really just depicts the fact that people are grabbing at some volatility premium going into these November elections. What's your thinking here on the VIX?
Well, looking at the VIX right now, spot is roughly 31, which denotes about 2% movements each day in broad markets. Again, looking at the skew, we can see that the IV is spiked for the November OPEX. Thereafter, it kind of settles down a bit. So I expect some serious volatility into the November 8th midterm elections, followed by a decline in volatility. However, if we do get above 35, look out, because we have seen in the past when we break above that key level, we can push as high as perhaps 50 or so, which would see us moving about 3.5% on average per day. I do agree that we may see some upside in the broad markets in the short term, especially if earnings are better than expected, but I think it'll be kind of short-lived overall. So yeah, keep an eye on the VIX, but remember that risk off above VIX 30, and playing safe here and protecting your chips a bit is probably a good way to play it in the short term. Now, moving on to the US dollar on page 4, Eric, has anything changed in your thinking?
Well, as I pointed out last week, the blow-off top and trend reversal to the downside that so many people were sure was going to happen hasn't happened yet. Now, we haven't seen new highs above 115 on the Dixie yet, but to my eye, nothing about the chart rules out that outcome. So as far as I'm concerned, it's wait-and-see time, and a sustained move to new highs on the Dixie would signal a markedly increased risk of a global foreign exchange crisis.
No, Eric, it's interesting that you make those comments on the dollar. The trend is still up, and every dip's been bought. So when we're looking at this chart, it's hard to make an argument that the bulls have dropped the ball yet. But you see such an overbought US dollar yen. That yen has been collapsing. You see that there's probably already meaningful bottoms maybe put in the pound sterling. And so really, in order for there to be a proper US dollar advance, it's going to have to come on the euro heading down to 95 cents or lower. And so there's, I think, fewer and fewer things that are working in the favor of the US dollar bulls in the short term. Doesn't mean it won't go higher, but right now I'm starting to ask the question as to whether there's enough gas in the tank to keep this going. Topping formations typically involve testing of highs on numerous occasions. One of the things that would be really interesting on the dollar would be if we did see a quick surge that broke the dollar to a higher high. Let's say we saw Dixie 115, 116 on the upside, driven by, let's say, a euro drop toward 95 cents or lower. And then we see that there's a big reversal and then it comes right back down. Then that could be something that could mark a key turn point. Now, I'm not predicting that per se, but I'm not so sure that I want to be too high conviction on the dollar, and I'm much more willing to consider a trend change if the technicals start to show it, which of course are not here right now.
No, Patrick, I definitely agree. And it might not be bad time to go long some flights to Tokyo right now. But let's move on to crude oil on page 5 over here. Patrick, what levels are you watching right now?
Right. So, I mean, we heard, the levels Eric is watching here, but I think here that it's really interesting. Obviously, we had, the administration come out with once again using the SPR as a weapon to suppress prices of crude oil. And what was interesting is that on the first reaction, crude oil dropped. And then it reversed. And what's interesting is that the lows of crude oil held toward its September lows. And one of the things I'm going to be watching very closely this week or into next week is whether or not the bulls can actually follow through back to and above 90. I mean, at this moment, any failed rallies below $90 can still roll oil over and keep it weak on the short term. I think in order for the bulls to solidify a new bull trend, we're going to need to see some sustained follow through to really kind of put the momentum in their favor. And that's certainly going to be what I'm watching. Now, let's move on, though, to page 6 where I have gold. Now, Eric, I have some insights on this weakness, but what's your thinking?
Well, Patrick, we had another massive down candle on Wednesday, almost reaching new cycle lows. Now, the explanation for that is easy. The dollar was up, so gold is down because gold hasn't really done anything except trade inversely to the dollar. But this happened in the face of mounting geopolitical tension. Now, I'm still long, but frankly, gold just isn't behaving the way almost everyone predicted that it would under these circumstances. We really need to get our friend Ola Hansen back on the show. The last letter that I saw from Ola, he was still very much bullish gold. I'd love to understand in better detail why he holds that view. Maybe we can get him lined up for a feature interview.
Eric, I hear you on the idea that gold is a hedge on geopolitical tensions, but the one trend that we have seen over and over again has simply been that gold has been acting like a cross currency to the US dollar, and you can literally overlay the chart of the euro on gold and see the similar correlation. I feel that the next dollar move is going to very much influence this move on gold. If we see the dollar struggling to make new highs, that could correspond with gold holding these lows along the bottom. And at the same time, if that much more bullish scenario happens and the Dixie's heading to 118 to 120 on the upside, I think that gold will just continue to follow that correlation and weaken down below 1600 in an impulse. So I'm cautiously actually optimistic gold, but I really think it's going to, at this moment, the low in gold will very much correspond with the inevitable high in the dollar. And I think you have to watch them together.
Now, moving on to natural gas on page 7, quite the pullback. What do you make of this drop over here?
It's interesting. A lot of people keep talking about this weakness and like a big surprise. But what's not being visible here on this nat gas chart is the term structure. And what's interesting is that the term structure, the long-term nat gas futures have always been down in this $4.5 to $5.5 area. We saw substantial backwardation in the term structure when nat gas was trading up in the $8+ area. And what we really have seen now is that backwardation just being taken right out. I mean, the farther parts of the term structure have barely moved, and this has really just been everything coming back almost in line. It'll be really interesting to see whether or not new catalysts emerge that could once again steepen that and bring the spot prices of nat gas up. But when you're looking out a few months, nat gas is really only up near about $5.90 on as you're going out here a few months forward. And so really this idea of $7 to $9 gas has really been just completely priced out of the entire term structure. And so I personally think while the support is coming in after such a decline, probably not too much immediate downside considering we're going into these winter months. But right now, I'm not so sure that a bounce is going to be much more than $1 on the upside. So it's going to be one of the more interesting things to watch as we move forward here. Now, on page 8 here, Nick, I've got the copper chart. And this has been also an interesting one. It's especially after listening to Louis' interview, obviously, thematically talking about this idea of what if China opens up and what would be the implications. And one of the commodities that I would suspect would positively react to a China reopening could be copper. And what's interesting is that really since that bloodbath in the summer where we saw copper prices wiped out from $4.5 almost down to $3 during the month of June into early July. And since then, we've really just seen a very long extended basing formations. Basically, copper really had no catalyst to go lower, but absolutely no reason to go higher. And the curious thing will be is if Louis' perspective does start to come to fruition for whatever reason, will that manifest in a turn in the charts on the copper? I think you can draw a descending trend line along all these September-October highs, look for that breakout north of 350, 360 to kind of really ask the question as to whether copper is turning.
On page 9, we have uranium. Nice trend over there. Do you think it continues?
Yeah, Nick, this is interesting because it's one of the few commodities that actually has been bullish in the last 3 months. And I mean, obviously, uranium went through an incredibly challenging second into third quarter as it really got hammered, almost 40% from top to bottom. But really, after solidifying that summer low, we've really seen progressively good price action. Every dip has been bought above a lot of its key trend lines and moving averages, and generally is showing signs of accumulation. It's one of the few charts that continues to behave bullishly. Interestingly enough, obviously because of some M&A activity with Cameco, the uranium stocks and the uranium ETFs have really been challenged in this period. But really, when you're looking at the underlying commodity, the commodity continues to do well. It'll be really interesting to see if those uranium stocks start to catch up now that all of that news is behind it.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.